I read an interesting quote that you used in one of your paid Investor Play subscribers list, and I thought it would be interesting if we kind of talked about it here. It's a quote from Warren Buffett, and it reads, something different happens all the time, and that's one reason economic predictions just don't enter into our decisions. Charlie Munger, my partner, and I, in 54 years now, never made a decision based on an economic prediction. We make business predictions about what individual businesses will do over time, and we compare them to what we had to pay for them. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years. And we have never said no to anything because we were right in the middle of a panic. But when you get into economics, there's so many variables, and the truth is you've got to expect good times and bad times in business. My question basically is can you expand on this and explain how this factors into your decision-making processes in the markets?
Yeah, I love that quote because during bear markets, we all become traders, and we all become obsessed with the short-term phenomena. We all become obsessed with what's driving the markets lower, macroeconomics, sentiment, this data, that data. And honestly, I hate this stuff, man. I hate every day waking up and checking on the 10-year treasury yield. You know, I hate waking up every day and having to see, okay, what are the jobless claims numbers? Where's the inflation data? Where's the PC? Where's the CPI? I hate doing that, man. I mean, literally, we have our little analyst meeting every morning, and it's a joke now. It's like, oh, where's the 10-year treasury yield at? You know, it's just like that's all we care about these days, and it is so annoying because it's not the fun part of investing. It's not what I enjoy. And it really is not what drives stocks in the long run. The 10-year treasury yield does not drive stocks in the long run. It's driving stocks today. And it's been driving stocks for 12 months because we're in this period of unusual market activity, unusual economic activity, unusual economic circumstances and dynamics. And during this period, everyone's obsessed with the short-term stuff. But at the end of the day, this too shall pass. Like 2008, 2009 passed, 2000, 2001 passed, 90, 91 passed. All these things always pass. Every time they're different, right? In 08, 09, it was all about the housing crash. And everybody at that time was obsessed with where are home prices going to go? How low can home prices go? And people thought that by timing a bottom in the housing market, that they would be able to time a bottom in the stock market and be able to get the best prices possible for assets. And part of that is true. But the fact of the matter is, if you just bought any good stock, any good company's stock during that period, regardless of when you bought it, early 2008, mid 2008, late 2008, early 2009, mid 2009, late 2009, regardless of when you bought that, you made a lot of money in the subsequent 3, 5, and 10-year periods. Yes, you would have made more money had you bought it in early 09 as opposed to mid 08. And if you bought it in mid 08, you suffered a pretty big drop between mid 08 to early 09. But we should not be short-term traders. We all want to be short-term traders in bear markets. We all feel like we have to be to protect ourselves. But the fact of the matter is, it doesn't matter if you bought in mid 08, late 08, or early 09, you made a lot of money in the 3, 5, 10-year window. Same is true with the whole dot-com washout. If you bought any time in late 2000, anytime throughout 2001, anytime throughout 2002, you made a lot of money over a 5, 10, 15-year window. Same thing with the 1987 flash crash. Same thing with the 1990-91 reset. Same thing with 1994-95 when we had a drop in the markets. Same thing in 1998 when we had a drop in the markets. Every time these things happen, the phenomena that cause them are different. We become obsessed with that phenomenon. We try to analyze the phenomenon because we all want to find the bottom. We all want to be the person that perfectly timed the bottom and made a bunch of money on the way up and didn't lose money on the way down. But the fact of the matter is, as Warren Buffett said, this is what economies do. They boom, they bust, they boom, they bust, they boom, they bust, they boom, they bust. And that is going to be the repeating pattern of capitalism, has been for centuries, will continue to be for centuries until somebody rewrites the rules of capitalism, which is not happening anytime soon and not happening right now. Therefore, we just have to adjust to it and understand that what good companies do is they thrive during the booms, they survive the busts, and then they thrive when the next boom comes. And the key is to just invest in those companies, knowing that they're going to go up a lot during booms, they're going to come down during bust, and then they're going to go up a lot more during booms, during the next boom. So you just got to find those companies, find good prices for them, buy them, and then wait out this economic turbulence, economic storm. And that's what we're doing right now. That's our investment strategy, Aaron. I talk about this 10-year treasury yield. I talk about inflation. I talk about the Fed because it's important to understand, and it's what people want to hear, right? It's people want to know, when are stocks going to rebound? When is a turnaround going to come? You know, how much lower can things go? What's the NAV math behind the S&P? La-di-da-la-di-do. People want to know that. So I dedicate a lot of analysis to it and try to give people answers because I want to give people answers. But at the end of the day, it doesn't matter. It really doesn't. Inflation will come down, whether it's next month, in 6 months, in 12 months, in 18 months, in 24 months, inflation will come down. Inflation doesn't stay high forever. It doesn't stay low forever, right? It goes high, it goes low. It's cyclical, so it's going to come down. The Fed is going to stop hiking rates, whether it's in 6 months, 18 months, 12, whatever it is, they're going to stop hiking rates, okay? Stocks are going to go higher. That's what they do. This is the U.S. economy we're talking about. So long as U.S. economy expands, these stocks are going to go higher. It's never the end of the world. So get rid of the apocalyptic thinking, throw it in a trash can. Those people are never right. Well, broken clocks are right twice a day. So there's this Jeremy Grantham guy, right? And he was calling the super bubble. He's a billionaire investor and a very, very good investor. And everyone thinks he's a genius now because he called the super bubble back in January 2022. He's called a super bubble in January in every single year since 2010. So he was wrong for 11 years and then right for one. Broken clock, right? Twice a day. So I just think that you cannot give in to the apocalyptic thinking. And at the same time, don't become obsessed with the near-term gyrations and up 5%, down 5%. Where's the 10-year treasury yield? What's the Fed going to do? Inflation, la-di-da-la-di-do. It's easy to become obsessed with that. I become obsessed with that sometimes. And I have to have my team pull me out and say, Luke, get your head out of that stuff. Like, look at the big picture. Is technological transformation continuing? Yes, absolutely. Are we using more digital money today than physical money? Yes. Is that share growing? Yes. Are we shopping online more? Yes. Are there really exciting innovations coming to online shopping, such as extended reality, augmented reality, enhanced online shopping? Yes, absolutely. Are we spending a lot of times on our phones? Yes. Is that time growing? Yes. How about streaming? Are we watching a lot of streaming? Yes. Are there really cool innovations coming to streaming? Augmented reality, metaverse, in immersive reality situations? Yes, yes. Is cloud growing? Is everything becoming remote, hybrid? Yes. Are we shifting to electric vehicles? Yes. Is clean energy becoming a big thing? Yes. Is solar dominating all new energy installations globally? Yes. Is hydrogen starting to come into its own? Yes. Is quantum computing this really exciting emerging technology field that promises to reshape computing as we know it? Yes. Is synthetic biology this emerging field that could rewrite the code, the DNA of life? Yes. Could that absolutely change everything about everything? Yes. Is vertical farming a new way to create food sustenance, food security, food independence? Yes. All of these things are still happening. They will continue to happen through this crisis. They will thrive once it passes. So zoom out and look at the big picture. Let stocks go down 10%. Let them go down 20%. Let your portfolio get hit 50%. So long as you are invested in fabulous companies, led by fabulous people doing fabulous things, then you will very likely make very good money in the stock market over the long run. You just have to have patience as your guide. And I think that's what that quote really means to me. And Buffett is the best investor of all time, and that's what he does. He doesn't care about inflation. He doesn't care about economic predictions or the Fed or interest rates or yields or anything. He just finds good companies. He finds Coca-Cola. He finds McDonald's, and he just sits and he just waits for them to sell a lot of drinks and a lot of burgers, and he makes a lot of money. That's what he does. And he invested throughout the 70s, which was this period of runaway inflation, way worse than we saw today. With the Fed that we talked about it, 75 basis point precedent, we had 94, 82, and then we had the series of them in 80, 81. Buffett was investing during all of that. So it's not like Buffett hasn't seen this before. Buffett has seen what we're seeing times 12 on steroids. And still, for 54 years, he never made an investment decision based on economic predictions or because the economy is going to do well over a 1 to 2 year period, or because the economy is going to do poorly over the next 12 months. He found good companies with great growth prospects and bought them at very reasonable prices. And if you just take that outlook and apply it to the market today, you are going to see so many opportunities, Aaron.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description, or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.